I want to switch gears and talk about streaming music. There was a lot of news in the industry this week, but Anne, just kind of big picture, the industry is still really booming, right?
Yeah, it's really booming, and you have a lot of really strong players. You have Spotify, you have Pandora, you have Apple Music, there's Google Play. It's kind of wide open, and at this point, it could be anybody's game.
I feel like I'm now finally on Spotify, and if it's only taken me, 10 years, but that must be a sign that it's gone really mainstream. But Steve, big news this week was that Spotify raised $1 billion in debt. So what's the significance of that? And why did they not just do a VC round?
This is like subprime lending coming to unicorn land. It was a terrible deal that they signed on to, and it talks about the fact that while streaming is doing well, the companies that are selling streaming are not doing as well. Their profits have not been good. Spotify, I believe, it's private, so I don't know if we really know the financials, but I believe it loses money. And the deal terms on this new financing are terrible. It's a convertible bond deal, and yet it has an interest rate of 5%. It starts at 5%, and it moves up to 10%. That's why I say it's like subprime, because it's like those 2 and 28 mortgages that people got. You get 1% for the first few months, but then it goes up to 10%.
We
right?
don't know what that happened there.
Exactly, and convertible bond rates usually are a few percentage points. Yahoo raised money in a convertible bond deal a few years ago, and it was lower than a 1% rate. So a convertible bond deal with a 5% rate, it's subprime lending.
So not good. So Anne, why would they do this? Do they need this money to buy up the growing numbers of competitive companies out there? Or what do you think is the plan there?
It's really interesting. And you look at Spotify, the fact that it is losing money is really alarming. But then you look at the growth of the market overall, you look at these new competitors coming in, and it starts to really make sense. Like, for example, SoundCloud has their new streaming service. It's $10 a month. And, it looks really promising, even though this space is really crowded.
Do you think, Steve, that this might mean that they are making plans to, how does this round, this debt, impact their plans to potentially go public?
There's incentives in the deal for them to go public, again, because the interest rate starts at 5%, and the longer they delay the IPO, it goes up 1%, I think, every 6 months. So that debt becomes more and more expensive. They're going to want to, they've set it up that way. The VCs have set it up that way to kind of inspire them to hit the public market.
Interesting.